The panel discussion is on future-proof digital lending for traditional and alternative lenders. We have an esteemed panel for this particular session. We will be announcing them soon while the stage is being set. Thank you.
Check. Mic check. Perfect.
Thank you, ladies and gentlemen. We are now starting with the next session. It's a panel discussion on the future-proof digital lending for traditional and alternative lenders. And to moderate this session, we have Ipsita Sur, who's in charge of emerging fintechs at the National Payments Corporation of India. May I request Ipsita to please take the stage? Ipsita will be speaking to an esteemed panel, and we have with us this afternoon Mr. Devraj Brahmachari, who's the head consumer digital lending and cards at Aditya Birla Finance. Welcome, Ipsita and Devraj. We also have Rajat Gandhi, who's the founder and CEO of Faircent. Welcome, Rajat. We have with us this afternoon Sandeep Sonpatki, who is the CBO at Lendingkart. Welcome, Sandeep. And we also have with us Shallu Kaushik, who is the EVP and Digital Head at Tata Capital Financial Services. Thank you for joining us this afternoon. Over to Ipsita.
Thank you so much for the introduction. Thanks every one of you for coming here, and thank you so much to the esteemed panelists. So I would begin with an introduction of the topic today, which is future-proof digital lending for traditional and alternative lenders. So as we all know, there's a deep connection between lending and economic growth, and it is a matter of common knowledge that all developed nations have hugely leveraged on lending to boost their economy and to improve the spending power for their citizens. So lending, as we all know, has evolved over time. It used to be barter and, indigenous financiers, and from there it evolved into a complex financial procedure before progressing into a modern system in the digital era. In India, however, digital lending is still evolving and it presents a patchy picture. While banks, they have been increasingly adopting innovative approaches to digital processes, NBFCs and Fintechs have been at the forefront of partnered digital lending. And it is through these partnerships they have been able to solve the challenge of timely credit to the underpenetrated markets, and they've been able to manage cost levers at every step of the process. Now, to throw some statistics, as per an RBI report, digital lending in India, it grew 12-fold between 2017 and 2020, of which 60% was contributed by NBFCs. And it is also estimated that digital lending will, the digital lenders will have almost 50% share of the total, share of disbursed loans by estimated about $350 billion by 2023. Now, given these numbers and putting them in context with the latest move by the latest guidelines by the regulator, which of course we will address later during the session, the future of lending is digital for sure. And with that, I would like to, open the panel. I would kind of pose the first question to the panel. And my first question would be to you, Shallu. So, I'm not going in any particular order. So, my first question would be to you. So, the COVID pandemic, as you know, it has compelled people across all, age groups to rely on digital platforms for various activities, not just lending. And it is during this time that, there was a sharp increase in prominence of digital lending apps. So, as an industry expert, you have, led digital transformation initiatives across leading private sector banks and one of the most respective NBFCs. How have you seen, the digital lending, landscape shape up during this COVID pandemic from the perspective of a traditional lender?
Sure. Thanks, Ipsita. So let me take a step back first. I would like to say not only COVID, earlier also there was a lot of innovation, a lot of practices relating to digital lending were prevalent. I would say COVID-19 just accelerated that, not only from a customer expectation perspective, but also the way financial institution actually adapted the customer needs. What I mean to say is that if the customers on one side were demanding more digital-led platforms, convenience, and credit, all type of institution came into that, be it banks, be it NBFCs, or be it new Fintechs who had come up. Now, what happened with that is it led to a lot of innovation, new business models emerged, and I would say not only corrected, in many ways it corrected many of the processes. We saw digitalization or phygital word getting used because a lot of physical processes getting merged into digitization. So, over a period of time, from then COVID time to now, I would say most of the lenders, including NBFCs or banks, have actually adapted multiple strategy. It could be doing by yourself, which is offering product by yourself, which is customer-led, right, or partner with a fintech partner, or a combination of both. So whatever suits their strategy, whatever suits their kind of thought process. That's the way I see over a period of time this has evolved.
Great, thank you so much for your views. Likewise from you, Devraj, I mean, you also come up, you have, experience across multiple domains in one of the most diversified and largest NBFCs in the country. How do you view this, what are your views from the perspective of a traditional lender?
So by a traditional lender, you mean somebody who has a brick and mortar business and a branch?
I mean, you came into existence sometime around 1991, so you have started,
exactly.
You've seen those days, so you've gone through those cycles, so yes.
So I think COVID just stopped things for us, right? I mean, anyone who has a brick and mortar business and there's a lockdown going on, right, things just stopped. So I think it impacted traditional lenders big time, at least for the ones who did not have any kind of digital, outreach or digital model to cater during those times. Now, my organization, we just actually had just about started digitally, just about maybe 6-7 months back before the lockdown hit us. And I think what it made us realize, and not just us, but when we talk to our partners, that the kind of disruption that the lockdown brought about didn't just affect the traditional lenders, it affected the digital lenders as much. It kind of really brought about a new paradigm because, and to give you just a small example, traditional lenders or digital lenders a lot relied upon bureau data, or things like income statements, like bank statements and salary slips. But when things came to a ground halt at that time, you never really realized that what you're seeing as a credit report of a customer is not really reflecting his actual state at that point in time. So I think well into the lockdown, people still continued lending just on the basis of data which hadn't changed. So this whole concept of lag effect that came along, and people realized that the score or the bureau data isn't going to be sufficient. There needs to be some alternate ways of knowing the customer. the huge amount of migration which happened, people who were there in cities and who were happily getting money and repaying it back now suddenly found both legs to become very difficult because they had to shift out of the city and go back to their village. It was a nightmare for collections. So I think all around, if you look at sourcing, underwriting, knowing your customer, the KYC processes, collections, all of each of these stages underwent a certain revolution, a certain disruption, stoppage, and newer innovation that really provided the resurgence of the industry about 8 or 9 months into the lockdown. So affected all, but I guess at the end of it, you got scarred, but you did come out with some good models, definitely.
Great, thank you so much. So Rajat, you're a niche alternative lender who has pioneered P2P lending in India. So what kind of change have you witnessed in the digital lending marketplace, during the pandemic from the perspective of an alternative lender?
Yeah, thank you for the question. So we are India's first peer-to-peer lending company, and I'll just step back to answer that question, why we started the company. We were not here to solve a problem of the banking system or the lending system or something like that. We saw a problem with the consumer, that he was not getting credit fast and cheap. Okay, and to solve for that problem, we actually went to the supply side, and we found that around 200 banks and actually 100 NBFCs control all the money supply. And our thesis was, if you want to bring a demand side disruption, that is, you want to give something faster and cheaper, whether it's Ola, whether it's Amazon, they all have gone to the supply side and created their own supply. Okay. And we said that, can we go to the people who own the money, that is you and us, you and I, who are the real creators of this deposit, which finally flows into the ecosystem. And with this thesis, we started the company. Okay. Now, our thesis was that you don't need to be dependent on these 250 banks for supply of capital. And our thesis came true during COVID. And because our lenders are multiple number of people, there are 250,000 lenders on the platform who are lending money. Now, their behavior was totally different from a traditional lender. I don't mean brick and mortar guy. A lender who has his own book and takes all the risk. Because our risk was so dispersed with our different lenders, we saw behavior on the lending side with the investors similar to what happened in the stock market. After the initial first month, stock markets boomed. We started getting a lot of investors who wanted, because they were sitting at home, wanted an extra income, and they started playing around with P2P also. Okay. And during COVID, we never had a shutdown. We originated, I think we would be one of the few lenders in the country, not lenders, a platform, which was originating a brand new loan every day of the lockdown. When I say a new application being serviced, okay, there were a lot of lenders who were lending to their existing customers. So it required technology, it required differentiated and alternative supply of capital. And I'm happy to share, not that I'm trying to talk about Faircent or something like that. During COVID, our platform boomed. So we started clocking more than 100 crores. We've done more than 3,800 crores of loans on the platform. And all of it, most of it is during the COVID. Because pre-COVID, we had just started our business. So I think there is a need for more innovation on lending side. We are not the only player out here. There are other players out there who are creating alternative supply of capital in different formats. Somebody is doing supply chain, somebody is doing, there are companies which are doing stuff on asset side of the things, leasing. So I think there's a huge need gap. One part P2P is trying to solve through an alternative supply. So long answer to a short question, but that's all.
No. So I think everybody knows Faircent here, especially, in the last 3 days, if anybody has picked up a bottle to drink water, they have read Faircent. So I mean, each and every person here knows Faircent very well now. Thank you so much for your views, Rajat. So Sandeep, MSME, it's a segment which is kind of notoriously untapped in terms of digitization. So while I want to know your views on how, the pandemic impacted, the digital lending landscape, I would also want to know, what has been your pain areas and obstacles in terms of, digital lending, because there have been government initiatives like Udyam Aadhaar and GST enabled data visibility. So the question, it's a dual question. How digitization impacts MSME, and also your views on the impact of COVID.
Sure. Thanks. Great question, Ipsita. So, I'm hearing what Shallu had to say and what Devraj had to say. Similar things that happened with us as well at Lendingkart. While we were a completely end-to-end digital platform to begin with, right? And back in 2014-15, we started doing MSME lending. The initial few periods of COVID was where everyone was staying at home, people getting dislocated, etc. There was some pain to begin with. But what it also encouraged is, from a customer side also, making sure that you have all the documents in place and you're able to provide all the documents for underwriting. We obviously had a completely digital underwriting platform with us. And we also started partnering with various banks. So as an NBFC, obviously we have a certain amount of capital with us which we can lend. But what COVID enabled is a lot of traditional lenders, right? Be it large private sector banks, public sector banks, who had a very, very physical branch-led lending model. They realized that they can't service those customers anymore when it comes to underwriting or assessing. And they were started opening up and saying that, okay, can we partner with a new age lender like a Lendingkart? And can we jointly offer loans? And that's around just probably a year or two prior to that, RBI had also come out with the co-lending guidelines. And really, COVID gave that impetus to the co-lending guidelines. And over the last 2 years, we have actually significantly moved a lot of our portfolio on the co-lending platform. Right? We today have about 20 plus lenders, which comprise the banks, NBFCs, public and private sector banks. And 90% of our book today is originated on the co-lending platform. So that's really, I would say, is a big push that has happened with the COVID and the entire digitization that has happened. It's not just alternate lenders like ourselves, but also has encouraged the traditional lenders also start adopting that practice. Right.
Thank you so much to all of you. So what we hear is that, it was the COVID, it was the pandemic which actually really pushed even the traditional lenders to move on the digitization front. It, of course, Shallu, like you said, it accelerated the, adoption of digital lending by a few years, if not 10 years. Some people said 10 years. So it led to new business models, proliferation of lending fintechs, and large-scale co-lending, collaborations, disruption, and alternative scoring mechanisms, like you mentioned. So not just for for sourcing, for KYC, for collections, increased adoption of digitalization. So and probably I don't know if you. Probably this was the inflection point when a lot of concerns got raised around the engagement of third parties, the ethical business practices, exorbitant interest rates, and breach of data security. So to ensure that the customer interest is taken care of, RBI came out with a set of guidelines. There were some directions given earlier, but the firm guidelines came out early in September of, just earlier this month. So they primarily focused on regulating the entire value chain and direct dispersal of money into the account of the customers without any third party involved, and then providing transparency to the customer through detailed disclosures, and empowering the customer with, giving them power over how their data should be used and disclosed, and of course, easy loan exit options amongst others. So, of course, the onus, all of you are regulated entities. The onus of, ensuring that, all the compliances are taken care of was put on the regulated entities. And, it kind of, of course, it addresses a lot of gray areas, and it brings about a lot of clarity in the digital lending landscape. So, and I'm sure the audience here would kind of is here, and they would want to know more about the digital lending guidelines and the impact that it had on the digital lending ecosystem. So, I would kind of want to begin with you, Rajat, for Faircent, since P2P business, it thrives on partnerships. How do you foresee the new guidelines affecting the business over the next few months? And how would the P2P lending ecosystem's expansion strategy change around the same?
Yeah, thank you. Great question. I'll try and attempt and answer it. So there are various parts to the digital lending guidelines. Firstly, we don't know which part applies to us. We're trying to grapple with it. So we always thought we were a digital lender, which was regulated by RBI. New sets of guidelines have come in, and we're trying to understand that. On the partnership front, I think this ecosystem, this such high dependence on partnership when I see all lending companies working with it. It's good, but the risk sharing part which was happening in the FLDG model and all that, anyways, we saw that it had a lot of pain, and anyways, we were seeing defaults happening even with the partners, well-funded partners. So we as a company, we took a view that we'll not do that. Anyways, forget about the guidelines. It was not making any sense because the risk pricing was not happening. And whatever was happening was more like experiment rather than actually happening. I'm a little confused about the fact that the money has to go to the borrower's account and those things. Because there are certain use cases, I think they've come out with some clarification that use case can be, if there's a use case, then you can do it. So personally, if you ask me, the collaboration and the partnerships will go around technology, working together on that. But on risk sharing, unless the co-lending model, which is mandated, or rather has the blessing of the regulator, other models may not work in the long term. And with respect to P2P, I think P2P has grown a lot through partnerships, whether on the supply side or on the demand side. We've seen different models come up. Cred is doing, BharatPe is doing that in partnership with certain players. So I think that will accelerate. And yeah, so that's the kind of a answer I have. Not a very fixed answer, but I've attempted it.
Great. Thank you so much. So Devraj, how do you foresee the guidelines shaping the lending ecosystem across multiple stakeholders? I mean, are they aiding us to be future ready, or they're restricting the entities and fintechs from in terms of innovations?
I think I'm going to answer that.
No, I'm talking about the industry in general, but you can of course speak specific to your organization.
So I think we've been a systemically important NBFC for quite some time now. So we're quite used to RBI's presence. A very deep presence. We are audited as much as what a large bank is. So I think when we went into digital lending as well, I don't think we were surprised when RBI comes, with different regulations, and it's the name of the game. And what we need to understand is that the way, and just what we spoke about in the previous question, the adoption of digital as an overall way of life, and the proliferation of apps and platforms which are making credit, easy access of credit available to the millions in our country, it makes that whole ecosystem systemically very important.
Right.
And since we're talking about credit and we're talking about introducing a certain kind of risk into the overall economy, and with large banks being present, NBFCs being present, it's but natural that it will invite the attention of the regulatory body, and good it does. Because I think, and I would really like to re-quote Mr. Shaktikanta Das, our Honorable Governor, what he said, that, it's like driving on a road without traffic lights. And we all know what that can lead to, the further and further you increase your speed. So I think we've got to look at regulations in that light. And I think more than enough number of times, RBI has said that, and even the latest ones, I think the latest guidelines are very, very, detailed. And if at all anyone had a doubt that, there is something which is restrictive, I think RBI has clearly put that to rest, that they are all in for a supportive growth plan. Because there is this whole idea of inclusion, right? And today, the model between the banks, NBFCs, and the fintechs is what is going to power the inclusion, financial inclusion of the people. Banks have not been able to achieve that in the 70 years of independence, or at least the first 60 years, right? So I think the model is something which RBI definitely recognizes, and at least the way we see it, our organization sees it, that it is not going to be restrictive in any way. But yes, there will be certain rules. You can't play any game without rules, and you have to adhere to those rules. And I think it's the way we say that it's extremely important to know who your customer is. You flip the coin, and it's extremely important to know who your borrower is. You just can't be giving something, or you can't be taking something just because it's easy to get, because there's an obligation for you to repay it. There's an obligation from the lender's side to collect it in the right way. So knowing your borrower is as important as knowing your customer. In the world today, wherein we're talking about, the lending apps which have been in contention, that, the money flow has always been, where is the money going? I think it's important as systemically important entities to understand where the flow of money is going. So I think RBI is really coming out with those kind of things, guidelines to ensure that, do you have the right answers? And I think it's important because, and I think just before, during lunch, we were also discussing that, you may agree, you may disagree, but there was a lot of things that was done which were not possibly the greatest things to do. Yes, there were experimentations. No innovation happens without experimentation, but innovation is needed to solve certain problems, not introduce more and more issues or challenges. So I think the guidelines that have come look supportive. Do we have answers to all of them right now? Yes, we don't. And as we look at it today, yes, we've been given certain time to implement those. We're constantly in touch with them. They're supportive in, kind of interpreting some of this. It's going to take a bit of time to implement, and that's where innovation comes in. I think the partnership between Fintechs and the traditional banks, NBFCs, is precisely for the reason. Let's get in the innovation to adhere to those rules and bring out certain solutions. So I think we're hopeful. We're hopeful that, this is by and large very supportive, and, it's only going to grow in the future, whatever we're going to be doing today. That's what our outlook is.
Great. So it would be premature to say that it can be restrictive to.
No, on the contrary, I don't think it's restrictive at all. As I said, right, when you walk on the road, when you drive, if you say that the red light is restrictive, then that's not really the right view to take. There will be certain guiding things. Yes, and the governor also said, right, we say certain things, we do not say certain things, and when we do not say certain things, we are still saying something. So I think मैं जो नहीं बोलता हूँ वो भी you got to keep that in mind. But I think they've been supportive largely, so it's not restrictive at all in our views.
Great. Yeah. Thank you so much. So brilliantly put out, driving on a road without traffic lights, as quoted by our Honorable Governor of RBI and re-quoted by Devraj. So of course, know your borrower should be equally important as know your customer. So I think it puts everybody on a level playing field. It's not just about the lender knowing the customer, it's also about the consumer knowing the borrower.
I think it's also in the principles of democracy, right? You don't push something down somebody's throat. It has to be a two-way street. It's an equal partnership. Just in the name of customer experience or growing your business volumes, you can't be pushing the wrong cart. Right. That's as simple as that.
Right. So we all talk about innovations and all in view of the RBI guidelines. I mean, what about costs? Shallu, I would kind of love to ask this question to you, So, of course, the guidelines ensure that the customer interests are taken care of. How are these, going to affect the cost factors? How are they going to affect the profitability aspects of the NBFCs, traditional NBFCs?
Yeah, sure. So before I answer that, first on the customer side, I'd like to put what are the contours of this guideline which is addressing to the customer or for the customer. In my mind, I like to decipher it like this. Guidelines talk about three key components. First, I would say ownership, where clearly what is the grievance redressal mechanism, how you can address the customer need. Second is on the transparency, what is to be communicated, how it should be communicated, who should be communicating. This is regarding transparency. Third aspect to that is the trust part of it. Consent layer, data storage, all of these are taken care in the guidelines. So what I'm trying to put across is customer angle in a form of ownership, transparency and trust has been taken care. So if I may put it as like an OTT, which has been addressed. Now coming to your questions, is this going to impact the cost? Of course it will impact the cost, some components of the cost in short run. But I personally believe these are good costs to have, and this will pay us back or pay back in the form of sustainable institutions or customer acquisition way. Because if this ownership, transparency, trust is not taken care, anyway the customers are not going to come back to you, or even if they are acquired, they will go out of your kitty if you're not addressing it properly. So in that sense, to some extent, this short-term cost has to be borne, which is a good cost to be borne for a long-term sustainability. That's what my view is.
Great, well articulated. So transparency,
Can
trust.
I just add to that?
Absolutely.
Because again, I'm quoting our Honorable Governor. I think there was one gentleman, out of the two questions that were asked to him, one was on FLDG. We can ignore that for the time being. But the other one that was asked of him was, can we provide some kind of a subsidy in the UPI card? You remember? I think there was one question on that. And then the governor answered in a very simple way that whenever you're having to provide certain cost subsidies, or in this case, if I link to, increasing costs and how do we kind of get it down, I think that's exactly the place where you need to innovate. So whatever costs that we are talking about today for a better tomorrow, I think that's ripe for innovation. And let's all figure out how we can bring those down. That's exactly where it is. You're following rules, yet at lower costs. So innovation is important.
Great.
And we'll expect the fintechs to help us in some of those things.
Great. So like we hear, I mean, these are good costs to have. Transparency, trust and ownership are the buzzwords. So we would like to know from you, Sandeep, too, I mean, how, do you see any ancillary businesses or products that could gain prominence given these guidelines? I mean, do you see, where there are guidelines, I'm sure there will be new opportunities there that will come up. So
Absolutely.
what do you think?
So what I think, what the guidelines have really done is really demarcate the roles and responsibilities of a regulated entity versus a service provider. Right? I think at the heart of it, if you really look at it, that's what RBI clarified, that if you are a regulated entity, these are the things that are all your obligations. So you have to make sure that you are collecting customer documentation. You have to make sure that the money goes into the customer's account, not into someone else's account. When the customer pays, the money has to come into your account. So RBI has tried to make sure that regulated entities do what they are supposed to do, and the regulated entities in turn then ask the service providers to make sure these things happen and hold REs responsible for that. What that really is going to do and help is take out a lot of these middle players who were playing the role of a pseudo-regulated entity. And that's what I think RBI is really trying to make sure that that area doesn't become grey and becomes very, very clear. So I think as the fellow members have said, that I think it will, in the long run, it will help because it will make it very, very clear who is lending and how is that entity lending. What I think it will also drive innovation is a better trust now between the regulated entities. And that's where the co-lending partnership that I talked about, right? There will be more trust now between an NBFC and a bank when they're partnering together and lending to customers, right? And in fact, at Lendingkart, that's what we're looking at as an opportunity as well. Because we see that there are a lot of innovations, like Faircent we talked about it, a lot of new innovations are happening, very, very niche, and they are really solving the problems, the fintechs and even Lendingkart to an extent. Right? And a lot of new models are coming up, a lot of niches are coming, and that innovation I think is best being done by the fintechs and the new companies. Whereas on the other side, you have availability of capital. And that's where the banks, the larger NBFCs have access to that capital, right? And they also want to experiment.
Right.
And what we see as an opportunity is, can we enable that experiment that the larger players want to do, and the smaller players want that capital to do that experiment. And that's where we are creating a platform which will help connect the two together.
Great.
Right.
In fact, earlier we were having that conversation in the lounge. You mentioned there are new lines of businesses that you're now getting into. So, do these guidelines impact that, or your plans were always there, and
Yeah, so the guideline actually enabled that, because for us also now, as we play the role of a platform, now we know that our expertise has been on the unsecured side for MSMEs.
Right.
But there are a lot of other wider financing needs that an MSME has. There are lab products available, there are supply chain finance available, there are invoice discounting, trade finance, and various other forms. Similarly, on the consumer side, a lot of innovations happening on the cards, on personal loans. Now, and India is, all of us acknowledge that India is an extremely under-penetrated, untapped market for when it comes to credit. And we can't be experts in everything, so we acknowledge that.
Sure.
So what we're really trying to do is tie up with other players, other innovators who have product innovation with them, but don't have access to capital. And we today have an established platform where we have large lenders with us who are keen to deploy that capital in different ways, want to experiment, but at certain levels are also bogged down by their own technology teams, right? Because a tech team can't integrate with 50 other players that are out there. So we have that platform in place. We are encouraging a lot more originators and innovators come to our platform. And we are then helping them connect with the large lenders and have access to capital and make that lending possible. So that's where we see a lot of opportunity come in, with the guidelines as well coming in, because now it becomes very clear it's an RE interacting with an RE.
Sure.
And then doing that.
Thanks a lot, Sandeep. So, do you have any views on this, Rajat? Any ancillary businesses, anything new, new opportunities for other businesses to come up given these guidelines?
I think I'm a firm believer and optimist that the headwinds are required for the aircraft to take off. So thankfully we have some headwinds in the form of these guidelines. I think they're quite restrictive, personally, if you ask me. And but whatever it is there. I think few ancillary businesses which will come up is pure technology, deep tech. In collections and recovery, I think there's a lot of play around technology to play its role, fintech. These digital guidelines will also help in asset-based lending, that is your secured lending, that is LAP, your other like vehicle finance, which is right now very under-penetrated from a technology perspective. I do not know too many fintechs which are operating in LAP and vehicle loans, and these are large segments of loan origination. So I think these are the few areas where the things will start coming up in my mind.
Great. So, Shallu and Devraj, I mean, being traditional lenders, so I mean, what do you plan? I mean, would you be more inclined towards growing your internal channels, or would you still kind of be kind of optimistic about new partnerships?
Well, I think it'll be a combination of both. You have to exist in all forms, because you have to, if I have to talk about our organization, we have a strong book of the way we've been sourcing conventionally. But yes, from partnership channels, we are actually putting a lot of effort there, because you have to be part of the ecosystem. And in some sense, it will really help not only to grow the book, but to innovate, to learn, to improvise, to bring more thought process to the full ecosystem. In that sense, yes, we will be actually present in both sides. Obviously, the percentage can skew depending upon the timing, but yeah, we are going to be there at both the places.
Sure.
Yeah.
Sure.
So the way we see it, and I was just referring to that whole value chain, right? So there's outsourcing, there's the KYC compliance, then there's underwriting, there's collections, there's servicing of the loan and the customer. I think in each of those stages, different entities will have expertise, and in every fintech kind of tries to specialize. It's rare that you find, and you really become generalists, and that's what we have been over the last few years. And that's the reason fintechs have been doing well, is because they're specializing in each of these. So I think partnerships will remain. Whether it remains for the entire set of the value chain, or it kind of is specific to a certain stage of it. So for example, when we started off, I think sourcing was the only piece that we were trying to solve, via a digital route, and that's where the ecosystem partners came into play. But I think as you move down, you do realize that in certain instances, they do have a lot more data of the customer than you do. And in those cases, a good understanding of that data is what you would leverage on them. In another case, I could have a much stronger collections framework in certain cities, or in certain buckets, which I could leverage more than what he does. And I think that is what we've got to figure out. It's a balance, it's a mix, and you really got to figure out your sweet spot with the kind of partners that you have. But I'll agree with Shallu, because I think digital lending still occupies just about 10% of who we are overall in terms of balance sheet and business models and operations. So the rest 90% does continue, and you do continue sourcing on your own, doing things on your own. But what I see is that this 10%, and that's what I'm seeing in my organization today, review after review, business meet after business meet, I think the only thing people are talking about is how does this 10% influence the 90? So what we are seeing is, you're never going to be traditional. So I may not give you an opportunity to call me a traditional lender for the third time when I'm there in this panel next year. But I think what we're going to do is essentially, digitize our way forward. And whether that's going to be a make internally or a buy through a partner, I think we'll take a prudent call. But it's got to be together in a partnership. It's always going to be that way.
Great. So thank you so much for the interesting insights on the RBI guidelines. So of course, I mean a lot of contrary views coming in there. I mean, like both of you, Shallu and Devraj, you seem very gung ho about this, and you think that this was the need of the hour, and it brings in a lot of important aspects about transparency, trust, ownership, and I'm not sure, of course, I mean, you will leverage on both the channels, internal channels and external channels, as as it is required. And of course, we also hear that it's also restrictive, like you mentioned, Rajat. So it's restrictive, but again, I'm sure, I mean, you'll find your ways, and I mean, there's still time. November 22 is the timeline set 30th, by the 30th November. Yeah. So 30th November 22 is the timeline that is set, 3 months. almost 2 months now. So are you all set? I mean, like there's just a quick feedback, are you all set for that? That's for new, I think, no, that's for the old, that's for the existing customers, and immediate is for the new customers, right?
So for us, it's not a major change. I think there's a few policy changes which are required in terms of partnerships and all that. But what my fear is that at some level, the innovation has to happen. The regulator has to see things from that perspective and let the industry do something let it do some stuff, let it break some stuff. And this overprotection of the customer, all the time talking about under that, you do not allow business. Let the business be there, there be capitalism. It's a basic thing. That's what I'm finding it's going away. The regulations are too minute, too operational. If they can give us an overarching policy kind of thing, okay, this is allowed, not allowed, as long as he's doing this. But if you start reading the guidelines line by line, it's just not possible to adhere to it. I have a 20-member team on compliance out of 200 people. Now, so these are one set of guidelines and the compliance. Then there's a whole compliance with Ministry of Company Affairs, right? And for startups and new businesses to go through this kind of compliance, I don't think, you just are adding the cost. Yeah, then in long term these costs are great and all that. But they are good for large organizations. But for innovation, they will stifle it. People are not breaking enough now. For innovation to happen, people have to make mistakes. Businesses have to go down. So I think that part has been restricted now. They're asking everybody to take an NBFC license. I do not know what's so great about NBFC license when you can create those kind of models otherwise also. So I think there is an alternative view. I have a different view on that. And it is important that the regulator needs to step back a little. It's getting too much into the business right now. So that's my understanding of the whole thing. Let's see what happens.
What about you, Sandeep? What is your view as an alternative lender? I mean, are you geared up to meet the deadline?
Yeah, so again, as a regulated entity, I think many of the things that all of us already did, I think there are some specific nuances that RBI has brought in more from a customer communication. Like for instance, I'll take the example of cool-off period, right? So where a customer takes a loan, and then there are, again, that's up to the lending organization to determine what that cool-off period should be, so that in that period the customer is able to give it back, which happens in many other products. Right? Today you order something from Amazon, you don't like it, you give it back. I think the same principle gets applied here, that you took a loan, suddenly you realize probably you don't want that loan, and you give it back. So those are some of the things that I think will require some changes, because that's not how lending organizations were geared for, and something that's come up new. So I think those are the things that I think all of us will work on.
I agree with you. The cooling off period, it's first time I'm hearing on a lending product. Yeah, insurance you can understand, but in lending, if somebody's taken a loan after signing an agreement, on one hand, you are saying that you have to sign an agreement, and then you're saying you're giving a cooling off period. How does it work? It's quite difficult to implement.
But don't you think this is more towards a customer empowerment? I mean, why not empower the customer with an easy exit option? I mean,
look, if a customer can vote and get a government in after, so he knows what he's doing. So at some level, that I said that these are mature adults. They're not people who are just galti se paisa unko mil gaya. So then there's a cooling off period. So I think at some level, the regulator also has to understand that the customer is a mature adult who's taking. Anyways, you can't give a loan to a minor, right? So if he's signing up something, and because look, end of the day, people are lending money, they're sending money to your bank account. Who takes care of the transfer charges and everything, right? Everybody's making money in between. So bank, when I send money, there's a cost, right?
Sure.
And it's a contract which has been signed. So these kind of cooling off periods, I'm not a great fan of, at least, because it's very difficult to implement in the lending product. Insurance, you can still do it. That's it.
So we would be eager to know, I mean, would you both differ on this? I mean, do you think should the customer not be given that option of an easy exit?
I have a little different view on this, and as far as the timelines are concerned, so see, somewhere They had anyway given us little heads up when the draft guideline came, and you knew what something was coming this like on your way. And some of the practices already existed in some form or the other, the conventional way that the customer had a dispute on what was communicated versus what has been given. I think why this, and I'm just picking up one of the points which they're saying on the cooling off period, we've never heard that earlier, but now we are hearing because lot of these things are now becoming digitally enabled. Earlier it was a person is being assisted, there is a person-human interaction happening, multiple visits or whatever interactions are happening, but here it may be happening in a jiffy, right? Many a times you miss the fine prints. You actually do not pay attention to that, or it is not very clear in the value chain what were you signing up for. So in that context, maybe I personally believe this has come up. Yes, it does give empowerment to customer. It does bring a lot of pain from an implementation perspective, and a lot of things from you have to be very watchful on the book retention, the cost of retention. As a lender, you have to think through, because now you're sourcing and the loan is closing. There's a cost element also attached to it. There's enough and more pain on that. But I think over a period of time, this will settle in, because I also believe customers are not there just, and the guidelines also say that you can deduct a particular amount of APR and all that stuff. So somewhere I personally believe that the customers also are not going to fool around on that. It's obviously they will also become a little more mature and responsible for what they are signing up. They'll become more informed and they will take care. That's what my view is.
Surprising thing is this is only applicable to digital lenders. Offline, there's no cooling off. How does it matter? So, and actually people can use your money for 15, 20 days and they can get into that cycle free of cost.
Right. I mean, Devraj, what do you think about that? I mean, that's a very interesting point. I mean, it doesn't apply to physical lending. Why does it apply to digital lending, and who would you side up with?
So I think I'm going to step back here and let's just understand for a few seconds where's the psyche coming from. I think there's been more than enough customer complaints which have gone to RBI saying that I never knew this was a loan. While you might argue that, you're not a fool, that somebody's giving you money for free, that, you didn't have money, somebody gave you money, and yet you didn't know it was a loan. Sure. Fair enough. I understand that pain, and I think I've handled services before, in one of my previous roles, and I do understand, sometimes customers can deliberately also come back with things which are very irrational, right. And as lenders, we get quite infuriated by that. How the hell do you think it's happening? So, but having said that, because this is a completely faceless engagement and interaction that you've had, you really do not know who's on the other side, and all that you have is a set of pages or an app in front of you. There are a lot of people genuinely who've fallen into trouble. Have the lenders been responsible for it? Not necessarily. But have the people still faced issues? They have. So I think when RBI comes, I think they do have a look at that, that maybe this loan wasn't even reported in the system. You've taken a 10-day BNPL, it wasn't reported. Right. Maybe the guy just didn't know that it was a loan, and it was just said that, okay, repay back after some days. But that you've had a bureau hit to your name possibly. I think some of those things prompted RBI to possibly say that, you better have a way of saying no, even if you've realized it a bit late. Does it work in a scenario like a personal loans wherein, you've got a full contract signed and everything done? Maybe no. But in case you've made a purchase and you're trying to finance that purchase and you just, I think it's somewhere down, there's a difference between consuming a Hotstar service for 3 days and say, I don't want it, take it back, versus taking a loan for 3 days and saying, I don't want it, take it back. I don't say that it's completely cooked, what's come to us today, and there can be arguments in favor of or in against, and I think all of us have approached the regulator, we are in talks, and somewhere down we will find an alignment. But certain things which have come as part of these, and this is only one part of the regulation, we're just addressing the cooling off period, but a lot of other things which have come into these regulations with respect to telling the customer exactly what he's signing up for in giving this entire, the key fact statement as we're talking about. Things like whether the money is directly going to his bank account and is it coming back from his bank account to mine. I think some of these have been very traditional practices which got a bit obfuscated in a digital lending sim, again, because it's completely faceless. Right. So Whether does it harm customer experience? I don't think it does. And that's what I'm saying. If it does, then that's an innovation challenge for us. I think we should be able to overcome that. Does it add to some operational changes and efforts and costs at our end? Maybe some cases, yes, it will. But as long as both parties, and there are three stakeholders to this, right? The borrower, the lender, and the regulator. I think if there is a fair amount of transparency established between the three of them, I think it's a good case to have. Because without if any one of them kind of get affected in a negative way, this industry is not going to grow.
Right.
And if we're really wanting to grow this in a sustainable way, there will be a few hiccups on the way which we have to adjust for, and that is what we see it as.
Right.
So again, I will reserve my view, and I know I'm contradicting Rajat out here, but we will reserve a view that yes, there could be some things which are constrictive today, but by and large, if we look at the spirit of it, and if we talk to the regulator, be transparent about it, we should be able to preserve the larger goal that we have of, growing this industry that we have.
Sure.
And yes, timelines, I think even there is 3 months, it's difficult. And I think we're also putting the same thing up to RBI, that, maybe we can look at extending it a bit, or maybe we can look at changing some of the exact things that are being asked for. But by and large, we will all be compliant, is what my sense is. So.
Great. So a lot of thought-provoking insights. I mean, is the borrower mature enough to take a decision and not kind of go back and not require the cooling off period? Or, of course, I mean, should we give the borrower the benefit of doubt? I mean, after all, it is faceless lending. I mean, why not give him that option that they have when they are transacting for other activities on digital platforms? They always have a return policy. So, I mean, of course, a lot of contradictory views again, and very thought-provoking for, our audience. So, I mean, moving on from the RBI guidelines, I mean, while we have been very gung-ho about, alternative, scoring mechanisms and sourcing and everything, I mean, the real profitability in terms of the entire life cycle of the lending comes from collections. That's where, I mean, unless you're kind of the return on the asset, right? So, unless you're actually collecting the money from the customer, you're not actually registering profits. So, I would like to kind of get a quick view from all the panelists on innovations that you have seen in the recoveries of loan, starting with you, Sandeep.
Sure. And in fact, I'm new to lending, right? But the favorite thing that I've heard from all the lenders is that lending is the simplest thing in the world, right? Anyone wants money, you can always give money if you have money. The biggest part in lending is about collecting.
Right.
Because unless you're able to collect, you will never make money in this profession. So you're right that collections is the critical one, and surprisingly, the amount of innovation that we've seen has not been as much as what you see in underwriting. People have invested, I mean, private equity money has come and invested tons of money on, okay, how can we underwrite customers, how can we take a decision. But relatively, I don't think collections has that much of tech-enabled or tech investment that has happened, right? It's a large part of the collections also runs on physical today, where you have agents, etc., who will help you go and collect that money. But in terms of the tech thing, that what I have seen happen, at least at Lendingkart, is because we also invested heavily on the collections side as well. There are a lot of innovation happening on, let's say, skip tracing, where customers are not traceable anymore. Then how can you trace that customers? How can you find other alternative addresses, right? So, and a lot of the data that we collect at the time of underwriting actually then comes to our rescue, because you get data from GST, you get data from Udyam Aadhar, you get data from bureaus. Bureaus also give you potential addresses, potential contact numbers. So a lot of that data we start mining to see that, okay, what is the alternative address where the customer can be made or can be available, where we could reach. And especially helps for a digital lender like us, right? Because we may not visit each and every customer's house when you give a loan. A lot of lending happens digitally for us. So that skip tracing is very helpful. We also have invested a lot on data models, which can actually also predict what is the bounce rate of a customer, right? And really try and focus on that, okay, out of the 100 cases that have bounced today, maybe 90% of them will give it back. It's just a matter of delayed payments here and there. In a week's time, they'll make the payment. So let's not focus on them. But these 10 customers are really the ones which are high risky, right? And can we focus our collections effort on them rather than spreading ourselves too thin? So all of that innovation, I think, is helping us optimize on how we collect and bring more efficiency and more effectiveness.
Sure. Shallu, would you have some view on this?
Yeah, so I feel collections has three key tenets. One is the how you collect, basically communication, how you are talking to customer, right timing, heuristic based communication. Second part is the cost of the collection. I'll elaborate them. Third is data. How are you using data for this? I believe in all aspects there is something or the other happening, and lot of work is happening around. Yeah, internally, externally, with partnerships, a lot of things are happening around it. If I have to address the first part, what's happening on the collections, so since we are talking digital lending, we all know, we all understand the average ticket size of the loan here is quite less as compared to, you know, big ticket size loans like home loan or loan against property and so on. So how you collecting with the customer is very, very important. Are you communicating it right? So what level of communication you are doing, right timing of the communication, which language are you communicating, because is the customer understanding what you are trying to communicate, and is he going to pay you back? How is he paying back to you? Because you can't send a person at customer house for 2 times for collections for a loan amount of 8,000 rupees. You can't be sending a person 2 times to collect that, right? So addressing that part of it. So a lot of work is happening, I would say, on the platform, on the way you communicate. You know, there is a lot of virtual IVR concept, telephony concept, all of those things are already in place and they're just getting better, I feel. Now I'll address the third part of it, data, which is the bedrock for all of this, because it's very, very important to understand the customer, profile the customer, who will end up paying through a low-cost channel, high-cost channel, which language-based channel. I'm just giving examples that how data will play the role for the above 2 here. Because if you get the data right, it's very, very likely the first 2 will start falling in place quickly for you. Because then you are actually categorizing the customer right, and you are making him pay from the right channel. So by that methodology, either you get the right platform or you get the right cost. You will actually get that right if you have these 3 tenets in place.
Great, thanks a lot, Shallu. So, I mean, while Shallu and Sandeep spoke about innovations in collection, I mean, innovation plus the human aspect, both. I mean, I'd like to hear on both from you, Rajat.
So the way we have approached collections is, I do not know whether it's different or not. I'll just share that part of it. One is the whole data part, which everybody is talking about, trying to build newer models of early warning systems where we can predict who's going to default in how much time, even if a paying borrower. The other part is that we worked a lot on technology part of it, wherein how can we automate processes, the workflows, at what time do you get into different stages of collections and recovery, right from sending a SMS to getting into legal online arbitration and all. And the third part, which is interesting, came as during COVID for us. We saw a lot of borrowers were defaulting, or they were not paying back because the notional cost of capital had gone up. They had their salary coming in, everything, but they were holding on to money. And they were saying, okay, it's fine for me not to pay, I will pay later. Or they were who were looking for moratorium and everything. So we came out with a small experiment called EMI Ka Hero. Okay, and we said if you pay your EMI on time, you can win a gold coin.
Wow.
And no, it was lucky draw. Okay, and so we deployed some money and we experimented. We got a 20% lift, and that gave me an insight that when the whole collection teams across the ecosystem were hounding the borrower, we suddenly changed the communication with them and we went into an engagement mode. Because every lender was calling him and saying, paise do, paise do, paise do. Okay? Here is a company which is coming and saying you could win a gold coin. So I think that went, and that is now we are trying to implement across the board, wherein we are saying that can we incentivize and change the communication tone and tonality with our customer, and be on a continuous engagement with him. So it's easier said than done, because it's a big implementation across the platform. And we are not into saying that you pay your EMIs on time, you'll get 1 EMI off. So the whole approach is different on an engagement. Sure. So I'll share the, whenever the next forum, we'll share the case study if it comes through well.
Great. Interesting there. So, I mean, you have, one of the largest lending portfolios. How does it kind of shape up for you, you know, the collection, the innovation and the human aspect of collection?
So again, as a traditional lender, I think most of our collections was pretty much human based, and it was all field collections, which I think got impacted big time during COVID when you just could not, carry out your regular operations. So on the brick and mortar business side, I think the only innovations that we could do at that point in time is pretty much run one of these schemes. So not a gold coin really, but yes, the best ways that you can, give them some kind of an incentive, whether it's an EMI off, whether it's some kind of a settlement or whatever you can choose at that point in time to just help him, kind of give back whatever he can to the best. But I think when we moved on to digital, and that's when we started thinking a lot more on how, and we actually learned a lot also from the ecosystem. So I think you can clearly divide it into three parts, right? The largest part, hopefully, is the part which will pay back to you. So your innovations there are essentially on how do you reach out, what Shallu and Sandeep were saying, how do you reach out to them in the best possible way, using the best possible channel, because each person has a very different idea of repaying back. Somebody wants to be notified, somebody does not want to be notified, somebody absolutely hates dates and will give you exactly one day after the due date. You just got to, but by and large, this section pays you. So there is a certain innovation that you can do in terms of reaching out, and it's a lot of human innovation rather than a tech innovation, literally. You just need to know how he behaves. The other part is the ones who don't pay you. Within this, again, there are two types. Ones who cannot pay you back because there are issues. At the end of it, he's in some kind of a stress. So you go back to what you did during COVID times. Any kind of incentivization that you can do in a human way. And I think that's very important because you don't lose sight at the end of it of society overall, right? You've got to ensure some of those things to be done. So we have very strict policies internally. If there are any complaints which come from a human angle, I think those are dealt with very, very strongly for people who are internal as well as our agencies who we do employ. There's a very strict code of conduct. We actually enforce that code of conduct even when we outsource any kind of collection. So we're very strong on that part. And the last bit is somebody who does not want to pay you back. And I think here again, I would slightly, kind of contradict that, the innovations here are not just in collections. The innovations on reducing those who do not want to pay back ultimately go back to your underwriting. So I think if you are really focusing on good underwriting, the section who do not want to pay you back, and I think that's the goal statement. You want to reduce this section to as much minimum as possible. So just have people who will pay you back and have people who can't pay you back. And you got to live with who can't pay you back. That's really what I would say on collections.
Great, thank you. Thank you to all of you for a very engaging discussion, and with that I would like to open the panel up to audience questions. Sure, please go ahead. Yes, can you pass on the mic?
Hi, thank you for the engaging discussion. My name is Badal Malik. I'm a founder at Karma Life. We've pioneered an earnings-linked credit platform for blue-collar workers. I had a couple of questions around the whole structure of fintech and NBFCs, working together in the context of the new regulations. One is just on FLDG. I was just wondering, is the principle behind this, according to you, stopping balance sheet on rent type models, or is it, around any kind of FLDG structure? I mean, even say 10, 15% or a FD lean, or something that offloads a risk cap or a certain amount of risk that drives innovation. And just in terms of our history, I don't think so. We build our underwriting from work data, right? And we only did it because we were able to. When we went to NBFCs, we've even in the last 2 years of working with them, we have shaved 8 to 10 percentage points after demonstrating the model, but nobody would have done it otherwise, right? So again, I think to Rajat's point, how does this affect innovation? What's your take on that from what do you think RBI is actually thinking? One more question around the Oaken protocol. Because we're just trying to figure out what are our degrees of freedom here. We today are doing both underwriting as well as channeling, and sourcing and the UX UI part of it, both of, from a trust perspective, which are both important. Now, under Oaken, I think that those two roles are being dissected as TSPs and LSPs. And I'm just wondering, how do you see that playing out? I'm trying to practically understand what is, what does that mean for us? So any thoughts would be useful.
So,
yes, sir, go
So on FLDG, I think the latest guidelines say that they are governed by under the securitization guidelines, the synthetic route. Okay. Now, effectively, it says that right now they're not very comfortable with, especially between a regulated entity and a non-regulated entity, where you're taking a pseudo balance sheet risk. Okay. So, and as the governor said yesterday, it's still under discussion. They're still deliberating further on the full FLGD model. So let's see what comes out. So everybody is in the same boat, and to short answer, FLGD has been stopped. Okay, for now. On the
Any kind of offloading of balance sheet risk. I mean, it's the principle you
that securitization is there, you do that. You offload it. But this model where another lender, a pseudo lender is giving you assurance, either they should have a lending license and then they operate on this kind of a model, and or you buy the portfolio, whatever it is. So FLGD actually was not even working, because we also tried to do some stuff around that. Either the portfolio goes bad or it stays good. Okay, so that 10%, 15% doesn't really work. And that's the one part. The second question was around OSNA. I think that still has to play out. And the definitions around digital lenders, LSPs, DSPs is still a little fuzzy in my mind. Who's a LSP? When do you become a digital lender? So I think those are the other questions which need clarification. I think over the next 6 months, 12 months, we'll start getting that.
Great. Any other questions? Okay.
Hi, thank you for a very insightful discussion with diametrically different views in some places. As a fintech corporate lawyer, there are a couple of minute observations which our team saw in the September 2nd circular. One is that they've insisted on digital signatures. Now, the IT Act differentiates between digital signatures and electronic signatures. How is that even ever going to get complied with? These are observations. I don't think we expect answers here. And I was personally very surprised to see that there's an obligation to resolve disputes in 30 days. There's no way any dispute gets resolved. I can understand if you try to resolve it, or if you respond. The IT Act has actually changed from resolve to respond. There's a subtle difference. Because otherwise, if it's not resolved in 30 days, the NBFC has not complied. And a couple of other observations, which I will not take up time. I'm obviously not on the panel here, just an observation. But how can the RE ensure that their brethren, which is the LSPs and whoever else, DLAs, are adhering to all those guidelines? Is a contractual document fine by RBI, or which is what we do? Or realistically, does RBI look at a higher standard in terms of actually operational audit and things like that?
So I can answer the third one first. I think the guidelines are for the regulated entities.
They are.
So
They only apply to the regulated
yeah,
entities.
so ultimately it is the regulated entity which has to ensure that all of this is met. And whether the partner aids the entity in getting it done or the entity is individually responsible, ultimately the entity has to get it done. So a very classical thing is the key fact statement. So if I have to give out a key fact statement to the customer, I have a choice of sending it myself, or I have a choice of empowering my partner because he ultimately, has the tech front end. So it works both ways, and we can always come to a mutual conclusion. But at the end of it, as a responsible entity, it is our responsibility to see we're ticking all the boxes with respect to the customer, with respect to the guidelines and all.
Yes.
And to your second question, which was related to the 30 days dispute, again, I'm just saying out of experience that most of the times, I think 99 percentile of whatever issues are there do get sorted within 30 days, unless and until there's something which is seriously wrong with your system. And
It's comforting.
yeah, and you also got to see that so I think you also have to have a framework which is, approved by your board and obviously complying to the regulations, that whether it's genuinely a complaint or is it more of a request and a query gone wrong. And I think you've just got to distribute that and see whether or not you will have digital means of satisfying a lot of things today. And that's exactly what we're working for. Can we solve 90% of them real time? Can we do it STP? And whatever the rest, yes, it does. And as Shallu was saying, these are some of the costs that will come to us. So if we are handling 1 million customer base and we have to resolve everything within 30 days, we need to staff up a bit more. It just can't be entirely digital. So yes, that's definitely there.
Thank you so much.
Great. Somebody raised a hand there, that side.
So yeah, my query is with respect to, for bureau thick customers, I think digital lending has more or less matured across the industry. But for For the NTC customers, I think there is still a lot of hesitancy among the NBFCs also. Though fintechs have been more, bolder comparative to banks and NBFCs. So, I see even the bureaus, though CIBIL has tried to have some sort of NTC scores, to aid the lenders for lending. But I think, don't you think there has to be some sort of, coordination among the lenders and the bureau for some, scoring or universal scoring on NTC lenders also? Because I think there is something I think digital lending should focus for the next phase of growth.
So, in my view, obviously it depends upon the amount of risk the lender is ready to take on these customers. While some amount of scores, multiple basis, alternate data today has been built, but it will take some time to evolve because it completely depends on the risk appetite of the lender, whether we are ready for that or not. If there is a complementing data along with it, which is alternate data in any form and shape, that's always welcome, and there are methods to today take decision based on that. But
there are methods, but it's not standardized. And
yeah.
in the latest RBI regulation also, they have put some restriction on it, not boldly but a bit silently. So I think we'll need some support from RBI also on this, maybe to allow some sort of alternate data where lenders can use it.
That's what I was saying, because you need a little more freer regime for people. If you want to address this population new to credit. Otherwise, if it's only the regulated entities and they are going to operate out here, we'll get a 8% penetration of credit. That's the reality of India. Okay. Moment you want to go to the next 8%, next 10% of the population, people will lose money. There will be pain in building models, but somebody has to go through that. And with this restrictive models, you will be very difficult.
Yeah, so to some extent, I believe also the guideline also addresses that, because they have also said the reporting of such kind of thing has to come in forefront, which could have not been coming. But this will, in a way, build more structured data. Alternate data today is largely more unstructured, but by reporting, it will become more structured and it will actually complement the system.
So in fact, as a digital lender, right, and my view is that credit bureau or the score that you get is increasingly becoming just one of the inputs that goes into underwriting, right? Because a bureau score also today tells you how a customer has behaved in the past, right? If the customer has taken 5 loans in the past, whether the customer has paid them or not paid them. It still doesn't tell you that can I lend to him today, given his current situation. And the same issue, I think what Devraj said, right? When pandemic hit, you could not rely on that data, whether I can give a loan to the customer today, what are the income sources of the customer today, how much of a future, because my loan is going to get fulfilled in the next 2 years or 3 years, right? That call you can't take purely on the bureau score. That will just give you whether the student, it's like a mutual fund, right? You can't rely on the past performance to say that am I going to get performance going forward. And that's where as a digital lender, I think many players are relying on a lot of alternate data, and which I think Shallu said that it's still unstructured. It's still an evolution that the traditional lenders are still evaluating, assessing. They still prefer a bureau score to give comfort that yes, the customer has behaved well in the past. In all likelihood, the customer will behave well in future as well. But I think as the overall ecosystem evolves, I think my sense is that the bureau score become only one of the aspects, or probably even not. You will probably rely on more of the other data going forward to take a decision.
I think with that, we'd like to close the session today. And thanks a lot to the audience for listening in patiently. And thank you to all the esteemed panelists for your valuable insights and thoughts.
Thank you, Ipsita.
Thank you.